Lesson 6, Insurance Company Strength and Ratings. How do you know the company will be there when you need it? By the end of this lesson, you will understand who stands behind an annuity's guarantees and how to evaluate the financial strength of the issuing insurance company. Welcome back. An annuity may promise a guaranteed interest rate, protection from direct market losses, a death benefit or income that could continue for the rest of your life. Those promises may last for decades. That raises an important question. How do you know the insurance company will be financially strong enough to keep those promises when you need them? That is what this lesson is about. An annuity is a contract between you and an insurance company. The guarantees depend on the company's financial strength and claims-paying ability. Claims-paying ability simply means the company's ability to pay the benefits and obligations promised to policyholders. The insurance company, not the federal government, stands behind the annuity contract. That is why choosing the company is just as important as choosing the product. Annuities are not bank deposits and are not insured by the FDIC. This is true even when you purchase an annuity through a bank. The bank may sell the product, but an insurance company issues it. Annuities are also not protected by SIPC in the same way that eligible customer assets may be protected when a brokerage firm fails. With a variable annuity, the investment subaccounts may rise or fall with the market. The insurance company's rating does not guarantee the performance of those investments. It only helps evaluate the company's ability to meet the insurance guarantees in the contract. State insurance guarantee associations may provide a backup layer of protection if a licensed insurance company fails. However, coverage limits and eligibility rules vary by state. Not every owner, contract, or benefit is necessarily covered. Think of the Guarantee Association as a safety net, not a substitute for choosing a financially strong company. A large financial brand may include several separate insurance companies. Those companies may have different ratings and financial resources. Do not check only the parent company or the name used in the advertisement. Look at the contract for wording such as issued by, underwritten by, or obligations are the responsibility of. That exact legal company is the one whose ratings you need to review. Independent rating agencies study insurance companies and issue financial strength ratings. These ratings are opinions about the company's ability to meet its obligations to policyholders. The agencies may examine capital and reserves, investments, profits and losses, business risks, and the company's ability to withstand difficult economic conditions. A rating is useful, but it is not a government guarantee. Ratings can also change over time. 4 rating agencies are commonly used: AM Best, S&P Global Ratings, Moody's, and Fitch. Each agency uses its own rating scale. For example, AM Best describes A++ and A+ as superior, A and A- as excellent, B++ and B+ as good. S&P and Fitch begin with AAA at the top, while Moody's begins with AAA. You do not need to memorize every symbol. Just remember that an A from one agency may not mean the same thing as an A from another. Compare companies using ratings from the same agency whenever possible. Always check when the rating was issued. An old rating may no longer reflect the company's current condition. Also, look at the outlook. An outlook may be listed as positive, stable, or negative. A negative outlook does not guarantee a downgrade, but it may signal that the agency is concerned about the company's direction. You may also see a Comdex score. The Comdex combines ratings from several agencies into a percentile ranking from 1 to 100. For example, a score of 90 generally means the company ranks higher than about 90% of the insurers included in the comparison. The Comdex can be a helpful summary, but it is not a separate financial strength rating. Review the individual ratings behind it rather than relying on one score alone. A financially strong company can still offer a contract that is expensive, restrictive, or poorly suited to your needs. A rating does not tell you whether the interest rate is competitive, whether the surrender period is too long, whether a rider is worth its cost, or whether the annuity fits your financial plan. You must evaluate both the financial strength of the company and the quality of the contract. Here is a simple process you can use. Step 1. Identify. Find the exact legal name of the issuing insurance company. Step 2. Verify. Check current ratings from more than one agency when available. Review the date and outlook. Step 3. Compare. Compare the company with other insurers offering similar contracts. Do not accept much greater financial risk simply to earn a slightly higher rate. At the same time, a strong rating does not justify accepting an uncompetitive contract. Before relying on that promise for decades, investigate the company making it, check the exact issuing company, review current ratings, look at the outlook, and remember that ratings are informed opinions, not guarantees. In Lesson 7, we will look at several major annuity carriers and discuss how to compare their strengths and trade-offs. You are becoming a much more informed consumer. I'll see you in Lesson 7.